Hello, everyone, and welcome to SNF Dialogues, an initiative of the Stavros Niarchos Foundation. In recent years, the global economy seems to be going from one crisis to the next. The pandemic, the energy crisis, inflation, bank failures, and hovering over everything is, of course, climate change and the effects it will have. So, to help us understand what is going on with the economy, I have the honor and the pleasure to have here with me Nobel laureate and professor of economics at MIT, and the co-founder and co-director of the Abdul Latif Jameel Poverty Action Lab, Dr. Esther Duflo. Welcome.
Thank you.
And I have also global chief economist at Kroll and senior fellow at Brown University, Megan Greene.
Thanks for having me.
Welcome to both. Welcome to both. Thank you so much for being here. We wanted to ask you simple questions about complicated things. So thank you so much for being here, ladies. Let's start. Challenges to the world's economy have been making headlines, it seems, almost on a daily basis. If we consider all these financial events, from the debt crisis in Sri Lanka to failing banks in the US to the fury in France over pensions, all while a land war is being waged on European soil, does this indicate that global economic turmoil is here to stay? What do you predict? Let's start with you, Professor.
In a sense, we've been in a sort of global economic turmoil for quite a while. Even before the pandemic, Abhijit Banerjee and I titled our book, which we wrote before the pandemic was published in November of 2019, Good Economic for Hard Times. So there was no inkling of a pandemic coming, and yet there were pretty serious challenges on the horizon of different types. One is those that are related to the explosion of inequality, which in turn comes from a variety of factors, some of them technological. So today we are talking a lot about AI, but this idea that technology has been replacing some jobs and that people who lost those jobs haven't necessarily found something else predates AI and might be accelerated by it. I think what is a little new there, especially from the perspective of a development economist, is how the poorer countries are becoming increasingly the victims of events that are happening mainly in the richer countries. The biggest example of that is climate change, which is mainly caused by emissions that are in the service of our behavior in rich countries, what we consume, or the cars we choose to drive, and so on. Africa is responsible for essentially none of the emission, but yet it is in Africa that the cost in the next 50 or 100 years will be the largest. The other example is the pandemic. Again, going back to Africa, in terms of health shocks, there wasn't much to talk about in terms of the pandemic, especially in relationship with the other health challenges that the continent is suffering. But the economic impacts were completely disproportionate in the poor countries. For example, when the rich countries could spend about 27% of their portfolio on assistance to protect their citizens, the poor country could only spend 2%. And therefore, the impact on poverty was very large. And the impact on predicted growth, which is over for the rich countries, it's still very, very negative for the year 2023, 2024 for the poor countries. And the last one, the most recent, is the inflation and debt crisis. Europe and the US decided that fighting inflation was a utmost priority and increased their interest rates. By increasing their interest rate, they plunged a number of countries into a debt crisis. So 9 countries are already in a debt crisis, 27 are right near it, and 24 are down, are a little bit down in the corridor. Again, that is something that is nothing that they've done. It is just that there was an existing level of debt and then made worse by the pandemic because a lot of this debt was in the service of infrastructure that could have been used for tourism, but the tourists stopped coming. So this is, for example, what happened in Sri Lanka. And then on top of that, you have an increase in interest rate that makes the whole financing completely unsustainable. And therefore plunge the countries in an economic crisis that eventually once again hurts the poor.
Megan, you're a debt crisis expert. So let's get a little more into that, because seeing what's going on with the Swiss and the US lenders, it's starting to feel very reminiscent to how the 2008 financial crisis started. So can you briefly describe for us the characteristics of the current situation, how similar or not it is to the Great Recession, why it erupted now, and lastly, didn't we fix things with banks last time around?
So what we've seen recently is the failure of a few small regional US banks, Silicon Valley Bank and Signature Bank in particular. And then off the back of that, a sort of forced shotgun wedding between Credit Suisse in Switzerland with its big rival UBS. And a lot of it has felt very reminiscent of 2008, I have to say, as someone who covered both of these episodes. What felt most reminiscent of 2008 was kind of the overreaction in markets to every single development. If you look at kind of pricing for the Fed's rate path, for example, it has flip-flopped a number of times just over the past couple of weeks. So that's one example. I would say this period is very different from 2008, in part because we had 2008, actually, and we sort of know how to respond to banking instability. What we saw with the small regional lenders, SVB and Signature Bank, was that they had an unreasonable amount of interest rate risk. That's partly because of their clientele. So Signature Bank mostly had crypto clients, and SVB mostly had kind of tech startup clients. And all of these clients are really phenomena of a low interest rate environment to begin with. So they were being handed truckloads of cash by venture capitalists, which they were depositing at these banks, hand over fist. Now, as interest rates have gone up, of course, they're getting less cash. So deposits weren't flowing into banks as much as they were. And in fact, for these clients to actually meet payroll and pay their rent, they were starting to take deposits out already a year ago. On top of that, a lot of these clients aren't very creditworthy. They don't really have reliable income streams. And so banks weren't providing loans to them because they weren't the best candidates for loans. And so instead of extending loans, these banks were going ahead and sticking their money in what they thought were really safe assets like US Treasuries. The problem is that as interest rates started to rise, the value of those assets actually fell pretty significantly. And that was fine as long as they were just holding them on their balance sheet and didn't have to mark them to market. But as deposits started fleeing these banks, the banks actually had to sell some of their assets to redeem those deposits, and they had to sell them at a really big loss because the value had fallen significantly. And then real concerns about solvency came in. We got bank runs. The speed of the bank runs was unprecedented, I would say. You don't have to actually line up at an ATM anymore for a bank run. You can just open the app on your phone. So I think that took everyone by surprise. Credit Suisse was a very different case, actually. In some ways, it's sort of remarkable Credit Suisse hasn't been bought by UBS 3 times already. It's been in trouble a number of times before, again, mostly down to poor management. And so I would argue that these small regional lenders in the US and Credit Suisse were pretty idiosyncratic. The problem is that if you look back to 2008, many analysts were saying that Bear Stearns and Commerzbank in Europe were also idiosyncratic. So just because they're idiosyncratic doesn't mean that you can't get contagion and a full-on, banking meltdown. I don't think we'll get that this time around. I think what policymakers have done really is enough, particularly in the Fed, in the US, where the Fed has guaranteed all the deposits of the 2 failed banks and implicitly guaranteed all the deposits across the banking system. So the liquidity measures that have been implemented, I think, are sufficient. In Europe, I think that Credit Suisse, the deal between Credit Suisse and UBS, it's a positive one. I think UBS will be able to manage it just fine. I don't expect a ton of contagion, but these kinds of things tend to play out over a course of months, not days or weeks. So it's too early to say that we definitely won't have more financial stability going ahead. In fact, I think it's quite likely we'll have some kind of financial instability, largely because central banks are hiking rates and shrinking their balance sheets. And so they're withdrawing liquidity from the system. And so I think we'll continue to hit these pockets of market dislocation. Arguably all of the regulation that we put in place after the global financial crisis should have stopped this from happening. So there is a question about, what did we miss? Why didn't that work? Part of the problem in the US in particular was that the regulation no longer applied to smaller banks. I think we can expect that to change going forward. So we might get more instability, but I think, we're not looking at the kind of 2008 banking meltdown that we saw before.
That sounds good, reassuring. Now, Professor, you have spent years researching global poverty and showing how policymakers often misunderstand its causes. What measures should governments be taking to protect people and their basic well-being when they're facing all these considerable challenges, one after the other, in such a short period? And if you have some examples of what mistakes have you seen governments make in the past?
So I think the one biggest mistake that governments tend to make is to think that there is one solution to all of the problems that are in front of them, and to be looking for the magic bullet, and preferably a magic bullet that is self-sustaining, so that actually a win-win solution that doesn't cost anything really in the so one example of that, for example, that was very, very popular in the 1990s was microcredit. So the idea with microcredit is that because you can charge commercial interest rate to the poor, which tends to be quite high given the small amounts of money they borrow, they have such high rates of return that they are able to reimburse their loans, and therefore you can, even a commercial lender, for example, could make money and at the same time unlock creative energy among the poor. The error was not to think that that's a possibility. The error was to believe blindly that it is the way it's going to work. So microcredit is just an example of something that we thought was the one magic bullet that are going to solve all the problems, and it turns out it's maybe it's not been very successful in getting people out of poverty, and has led to some major problems even for some people in some countries. It also has led to some good things for some others. So it's the very type of product that you can think is not the solution to everything, but properly used would be the solution to some appropriate problem. In the kind of 80s and 90s, it was maybe the Washington consensus. So the idea that all of countries should pursue is economic growth, and economic growth is the way the leagues of nations are written. And if you are successful nations, you have high growth, and otherwise you have low growth. We really have no idea how to promote economic growth. It's not that economists or anybody has the formula. It kind of happens. We know how to prevent it to happen. Like for hyperinflation is not a good idea. We know, too many regulations, so people cannot do anything is not a good idea. But once you've taken care of the fundamental, we have no idea how to make growth happen. It varies from time to time. Bangladesh used to have no growth, and then used to have very rapid growth, and then less growth, and again rapid growth for reasons that we don't fully understand. That's the first reason. We don't have a cookbook for economic growth. The second mistake with focusing too much on economic growth is that should not be an end, that should be a mean. The end would be, welfare. In developing countries, simple things like being alive, like not dying in infancy or in childbirth, like being able to go to school, like being able to work if you're a woman, or to generally live your life the way you choose it. That those measures of welfare are not necessarily so closely related to economic growth. For example, in Africa, most countries in Africa have had very lackluster economic growth, but made a lot of progress on human welfare over the last 30 years, with infant mortality being divided by 2, maternal mortality being divided by 2, most of the children attending school, and so on. So more effective public policy that is aiming at outcomes which are, first of all, the important ones, human welfare and dignity and happiness. And second, we actually have tools that we understand work or don't work. For example, we have so many examples of things that have been done to prevent women to die in childbirth. Some of them have worked, some of them have not worked. They've been evaluated very rigorously, often by randomized controlled trials. So we can, as the next country, you can pick what has worked and not pick what has worked and use your existing money as efficiently as possible. So in the last 30 years, right up until COVID, has actually been an era of great progress in the poor, for the poorest people in the world, with diminution of poverty, improvement of all these measures of welfare. In fact, you know, in the context of all the turmoil that Megan was talking about, being a development economist was a pretty comfortable place to be, like, because things kept getting better. COVID has changed that, and we are not yet back from, we are not left the post-COVID era for the reasons I discussed earlier. But this progress, it's something to hold on to, because they are a direct consequence of giving up this kind of dream of growth to replace it by the, you know, hard-nosed practicality of achieving human outcomes that we've seen in many countries.
Megan, let's go to you and let's talk energy crisis. What are the main reasons for the energy crisis today? Is it just the war in Ukraine, or is there more behind it? And where do you see this going?
Yeah, so I would say the answer differs a little bit depending on geography. For Europe, clearly the Russian invasion of Ukraine played a huge part in creating an energy crisis. Though, if you go back before that, Europe's over-reliance on Russia, one source for energy, was already leaving Europe pretty vulnerable. So that was already an issue that should have been addressed. For the US, it's very different, because the US, of course, is completely self-sufficient in energy at this point, thanks to the shale revolution. I would say it was not out of consensus before Russia invaded Ukraine to say that Europe was facing an energy crisis. It was completely out of consensus to say the same about the US, and yet I was. And that's largely just because there's been chronic underinvestment in energy in the US, going all the way back to 2014, when there was the so-called Thanksgiving Day massacre, when there were huge moves in energy markets that left energy producers pretty traumatized. Also, if you think back to the beginning of the pandemic, oil prices went negative. I think a lot of energy producers were pretty traumatized by that. And so even if energy companies in the US have had profits, rather than plowing them into investments, they've been providing them as dividends back to their shareholders. And in fact, I think that they've been rewarded for doing that by investors, and they would probably be punished for reinvesting some of those profits in the oil patch. Now, part of that, as I mentioned, was down to previous oil price moves that we've seen. Part of it is also an actual intended consequence of the ESG movement. And the ESG movement, of course, is trying to encourage financial investors to invest in so-called green companies or green technologies. The reality, though, is that means that, 2 years ago, energy companies were some of the best performing equities in global markets, but they got almost no institutional money flowing into them, in large part because institutional investors were incentivized to avoid those companies thanks to ESG. I mentioned this is an intended consequence because it's all part of an attempt to shift away from fossil fuels towards greener sources of energy. And that in and of itself is a positive thing. But it's the choreography of that we're discovering is going to be really tricky, because you can't just stop using fossil fuels without having the renewables in place. So I think that there's a risk there that policymakers are trying to manage now. We've seen it in Europe in earnest as countries have reopened coal mines, but also invested hugely in wind turbines, for example. So, I think that's something that policymakers are still trying to figure out how to calibrate so that we're never left without enough energy, but where we can continue to make progress away from fossil fuels towards renewables.
Great, thank you. Professor, we in the media often use the term global economy, but how truly global is this global economy? Can you explain it to somebody who's not an expert, why economic developments in the West affect the poor countries of the world, and how do they do this?
So in some ways, we have a truly global economy. The pandemic is an example of that. It's not an economic shock, but it's a shock that had a lot of impact on the economy. And it was a global shock. At the beginning, in March, exactly 3 years ago, there was very little understanding of where COVID was and who was going to be hit. And the entire world really shut down as one, pretty much around March 15. Another example is climate change. Again, we have one world. The emissions have pretty much the same impact on climate, no matter where they are. And therefore, the choices that we make in terms of energy and others have direct impact on the warming of countries all over the world. The impact is disproportionately in poor countries because they tend to already be in places that are hot, and they also have less money to protect themselves from the consequence of climate change. So again, this is a shock that is the consumption patterns we have in the US have direct impact on the rest of the world. In fact, disproportionate impact on the rest of the world. Some of the estimate by the EPIC lab at the University of Chicago suggest that in terms of human lives, climate change is actually going to be a net positive for the countries in the OECD, because it's going to be less cold in the winter and people are not going to die of cold. While, of course, it's going to be extraordinarily negative in countries in Africa that, again, contribute nothing to the problem. So these are examples in which we live in a global world. The debt, the increase in interest rate at the Fed and the European Central Bank that affects the debt crisis in countries around the world is another example. In other ways, unfortunately, we are not that global. For example, the number of nations that have an active part in international trade is actually not that large. Many of them import, in particular from China, but don't have any seats at the exporting table. So in that sense, for them, the world is not that global. Trying to penetrate the global market, even when they are generally liberalized, is very difficult because there are barriers to entry that are either regulatory or simply a matter of reputation and brand. It's very difficult for the new entrant now to compete with China, for example. So in that sense, we don't have a global world. So unfortunately, the nature of our global world is one in which the problems are mutualized, but the solutions aren't.
Do you think that we need to reconsider how global economic systems work? This is the last question to both. Like, are there systemic flaws? How can we make things smoother, better? Please continue, Professor.
In a sense, we have seen, for example, during the pandemic, the limit of the post-World War system, Bretton Woods institutions that have served us right for a period of time and are perhaps less adequate today. For example, in the negotiation about the over-indebtedness of some countries in the South, take Sri Lanka, in a old-fashioned Bretton Woods world, the IMF would have been able to negotiate a haircut for the lenders and to help Sri Lanka get out of the debt crisis. But because most of the debt is held by Chinese banks, and China has really no willingness to let their banks take a haircut unless it comes with considerable support, the negotiation over the situation in Sri Lanka has been extraordinarily difficult. So the composition, the change in the composition of who lends to whom, for example, has put our institutions, our kind of multilateral institutions, at a slight disadvantage in terms of ability to deal with the crises that we have. Another way in which we see that is that the biggest role that today the richer nation could have vis-a-vis the poor nations is to play a role of insurance provider. Because the reality is that the even poor countries have become less poor. They are growing, their economies are becoming bigger, the generosity of the rich countries has not increased. So in typical time, there is very little really that a foreign country can contribute to a poor country in the world in terms of favoring their development. When it really becomes essential is when there is a huge crisis. Because when there is a huge crisis, if you're a rich country, you can borrow to finance the whatever it takes that has been fundamental, for example, during the COVID crisis, at very, very low interest rate, because people know that you're going to reimburse eventually. That's not true for most of countries in the world. They can't do that. So I think our critical role would be to be able, as a set of rich nations, to ensure the poor nations against catastrophes, in particular the looming climate catastrophes that are coming down the pike, but also things like global pandemic. And we've shown during the pandemic that we're completely unable to do that. We don't even have the mechanism. So the aid didn't go up, but even when there was an attempt to do something with the DSTs at the IMF, I think it's English DTS, the special drawing rights, to allocate this money creation towards the poor countries, it's just turned out to be very difficult. We're not equipped to do that. So I think there is a lot of things we can do. I think we need to find a systematic way to fund the loss and recovery fund for climate change that was discussed in Sharm el-Sheikh. The fund was created, but no money was put into it, and no mechanism to put money was put into it either. So the new multilateralism is to get together and agree how we are taxing individuals or companies at a global level to fund something like that. And this is something which I'm not sure I see the political process that leads us from A to B. But I'm a glass half full person. So I very much hope that we're able to do that in the next few years.
Super, thanks. Megan?
Yeah, so I would reiterate one of Professor Duflo's answers from earlier, which is economists view GDP growth as the gold standard, but actually GDP growth doesn't tell us a whole lot about a lot of really important things like distribution. So rethinking economics so that we include welfare more into our metrics, I think, is something we should look at. Also, the new approaches to economic challenges group at the OECD has done a lot of interesting work on how we can actually just think of economics completely differently. So instead of assuming there's a single equilibrium for an economy, consider that the economy is more of a living, breathing organism that responds to things. And so there are multiple equilibria and they can actually move. That changes the nature of what our goals and policy are. And then also, finally, I would just say, I think economists think of the world in terms of really simple actors, rational beings that exist in a really complex world. But most other sciences view the world through a different lens, which is really complex actors in a really simple world. And so I think economists might study what other sciences, hard sciences in particular, are doing in terms of their models and their forecasts, and could adopt a lot of lessons there.
Super. Thank you both so much. Have a great week and maybe see you soon.
Thank you so much.